All right, let's get right into it. Welcome, everyone, to this premium masterclass explainer. Today, we're unpacking one of the absolutely critical areas of tax computation for any professional, Section 19 of the Income Tax Act 2025. Now, as tax professionals, advisors, and students, we all know the basic drill, right? You calculate the gross salary, you account for perquisites, and you factor in profits in lieu of salary. But your job doesn't end there. Section 19 dictates exactly what can be deducted from that gross salary to find the true final income chargeable under the head Salaries. Master this, and you literally master salary structuring and compliance.
Okay, let's dive into this. To lock these rules into our brains effectively, we're mapping them directly to an employee's career lifecycle. We'll start with standard and professional tax, then move on to gratuity computations, commuted pension rules, retrenchment and VRS, leave encashment, and finally we'll wrap up with the crucial conditions and master limits.
Starting off with Section 1, Standard and Professional Tax.
Right out of the gate, serial number 2 gives us the standard deduction, and listen, this is a crucial exam point. The standard deduction is exactly 75,000 rupees, or the total salary amount, whichever is less, specifically when tax is computed under Section 2021. But for literally all other cases, it's capped at 50,000 rupees. It's a simple detail, but you absolutely do not want to mix these two up when computing returns or sitting for your exams.
Now, right alongside that under serial number 1 is the tax on employment, which we all know as professional tax. The rule here couldn't be simpler. Any amount paid by the employee as a tax on employment under Article 2762 of the Constitution is a straight-up 100% deduction. If it's paid, it's fully deductible. No complex formulas required here at all.
Moving on to Section 2, Gratuity computations.
All right, this is where the mathematical heavy lifting begins, and it's also where we hit our first major government versus private divide. Notice how the Act structurally separates employees here. Under Serial 3 and 4, death cum retirement gratuity for government and defense personnel is entirely deductible. It's a complete tax shield. But for the private sector, the other employees under Serial 5 and 6, strict mathematical limits apply. If they fall under the Payment of Gratuity Act, the deduction is capped by those specific rules. But what if they don't?
Now, what's really interesting about this is the specific formula for those other employees under Serial No. 6. For folks retiring, becoming incapacitated, or terminating employment, their deduction is the absolute minimum of 3 things: the actual gratuity received, the central government's notified limit, or the specific formula, 1/2 multiplied by A times B. A is the average salary for the 10 months immediately preceding the event, and B is their completed years of service. It's a very precise calculation, and you have got to get those variables right every single time.
Next up, Section 3, Commuted Pension Rules.
Once again, government employees, defense, and specified funds get a full 100% deduction, but for private sector employees under Serial 8, watch out for this classic CA exam trap. The deduction here depends entirely on whether the employee also received a gratuity. If they did get a gratuity, their commuted pension deduction drops down to just 1/3 of the normal pension. But if they walked away without gratuity, the deduction is a bit more generous at 1/2. The tax law is basically just balancing out the overall retirement package here.
Let's move to Section 4, Retrenchment and Voluntary Retirement, or VRS. Let's see how the law handles unexpected exits. These are sensitive situations, and the tax law does provide specific safety nets. For retrenchment under Serial 10, the relief is tied directly to the Industrial Disputes Act. Your deduction is the minimum of 3 amounts: the actual compensation, the limit under Section 25F of the IDA, or government notified limit of at least 50,000 rupees. Now, under Serial 11, if the scheme is explicitly approved by the central government, the whole thing is deductible. Also, keep the Section 2C conditions in mind. This relief legally covers the closure of an undertaking or a transfer of ownership where the new terms are worse for the employee. Then we have voluntary retirement under Serial 12. There is a very strict master limit here, a maximum deduction of 5 lakh rupees. But be super careful with this one. It doesn't apply to just any company. It is strictly restricted to employees of the public sector, universities, IITs, co-ops, local authorities, and the government. On top of that, there's a strict no double dipping rule. If your client already claimed relief under Section 157 for a tax year, they cannot touch this VRS deduction. And maybe most importantly, this is a once-in-a-lifetime deduction. Once you use it, it's gone for good. Moving to Section 5, Leave Encashment Calculations. Okay, transitioning to the final direct salary component, cashing out earned leave at retirement. We're seeing a really familiar structural theme again, aren't we? Under Serial 13, for government employees, the entire cash equivalent of their leave salary is fully deductible. But for other employees under Serial 14, the tax shield has its limits. They have to pass a pretty stringent four-pronged minimum calculation test. Let's break that down.
So the crucial point is this four-step test. The allowable deduction is simply the lowest of these four amounts. First, the actual cash equivalent, capped at 30 days of earned leave for every year of actual service. Second, the 10 multiplied by B formula, where B is their average monthly salary for the 10 months right before retirement. Third, the central government's notified limit. And fourth, the actual cash payment they received. Whichever of those four is the smallest, that is your deduction.
Finally, Section 6, Crucial Conditions and Master Limits. Now we need to bring all of this together. Knowing the serial numbers just isn't enough. We have to look at subsection 2, which is basically the operating system running all these deductions behind the scenes. Miscalculating the definition of salary is literally the #1 practical error made by professionals. For gratuity and leave encashment calculations, salary has a very, very strict definition. It includes basic pay and it includes dearness allowance, but only if the employment terms explicitly say so. Crucially, it absolutely excludes all other allowances and perquisites. Seriously, if you throw a perquisite into your 10-month average variables, your entire computation is going to be wrong.
Which brings us to a highly practical, real-world scenario. Let's say your client is a serial job hopper. What happens if they receive gratuity or leave encashment from multiple employers, either in the same year or across different tax years? Can they just keep claiming that maximum notified limit every single time they switch jobs? Well, no. This brilliantly illustrates how the government stops endless exploitation of those statutory limits. Subsection 2 introduces the overarching A-B master limit rule for both gratuity and leave encashment. A is the absolute maximum limit notified by the central government. B is the total amount of deductions your client has already claimed in earlier tax years from previous employers. To find out what they can deduct today, you just take A and subtract B. Think of it like a lifetime bucket. Once it's full, it's full. So, having mastered the exact rules, the formulas, and the strict definitions of Section 19, the real test begins at your desk. Knowing that standard deductions shift based on the tax regime, that commuted pensions rely on gratuity status, and that this A-B wall tracks your clients across their entire career, how will you structure your next client's salary? It's like a giant puzzle. How will you maximize their deductions while staying perfectly compliant with the Income Tax Act 2025? Take these masterclass insights and start applying them directly to your advisory and return filing work. Thank you so much for joining me on this explainer, and I'll see you in the next one.